Well, Paytm declared its Q3 FY22 numbers with the revenue jumping a solid 89% year on year to that 1,456 crore mark. When we look at contribution profit, that's gone up 5.5 times year on year to 454 crore. The EBITDA before ESOP now looks as 393 crore negative versus 488 crore negative year on year. Now, why are we taking out the ESOP number from that EBITDA number? Because there has been a large component of ESOP within the employee benefit expense in the P&L for this particular quarter. The employee benefit expense has jumped over 2.5x on a year-on-year basis, over 2x on a quarter-on-quarter basis. It's above that 830 crore mark. And this is a huge dent when you look at the bottom line loss. The bottom line loss is currently at 780 crore odd, which means that if we just remove the employee benefit expense or the ESOP, the losses have actually shrunk on both a quarter-on-quarter as well as on a year-on-year basis and shrunk substantially. So when we look at the loss in the current quarter, it's at, as I said, it's at 778 crore versus 535 crore in the year ago same period and 473 crore in the quarter ago period, which is Q2 of FY22. So largely Paytm seems to be making some amount of gains in on the profit and loss account of the company. When we look at what Goldman Sachs looks at within Paytm, it says that Paytm is a buy and they've upgraded their rating from a neutral to a buy. They say that the current share price implies that there are multiple headwinds for Paytm. However, the top line is showing strong growth and strong resilience there. So it says that the 89% growth in top line year on year in Q3 continues to be strong, and they expect that to continue to be so in the quarters ahead. When we look at where Paytm is trading, well, it's trading at around 7 times FY23 expected EV to sales as per Goldman Sachs. And Goldman Sachs hence believes that there is a 10% discount in this particular value metric when we compare it with global fintech. Paytm's revenue growth, what Goldman Sachs is projecting is it's at 35% year on year for the next 3 to 4 years, which is till FY25. So a CAGR of 35% is far higher than its global peers. However, the discount that Paytm is trading at is at a 10% discount to global peers, and hence Goldman Sachs believes that this is an attractive price to buy the stock. Besides this, Paytm continues to make market share gains as well across both UPI and non-UPI payments. And as the scale increases, Goldman Sachs expects that margin trends will also improve steadily. Now, mind you, Paytm's price has fallen 55+% from its IPO price of 2,150 rupees a share. So there has been a steep tank in the stock price. However, with Goldman Sachs' target price of around 1,460 rupees a share, that means that Goldman Sachs believes there's a 50% plus upside to the stock from current market prices.